Welcome, Generational Wealth. In this video, we will go over confluences. So these would be the confluences I look for when I'm trading. So first thing you always want to know is the highs and the lows. Because trading off the highs and the lows, of course, you will get your M and W formations, but most of all, you will get a higher risk to reward ratio on the trade setup. So the highs and lows is what tends to be the market maker go-to of reversing this market. So me personally, I always look for a trade to be off the high or a low, forming either a M or a W formation, as well as included a stop hunt to induce. So trading off the highs and lows, like I said, will give you a higher risk to reward ratio when trading. Because if you think about it, if price is here and you get in here, what better chance you have of catching this move back to the downside than to risk this small amount of pips, 15, 20 pips, on taking what could have been a big move to the downside, because we see this happen all the time. These playing off these highs and these lows, this M and W formations. So always try to get a trade set up off a high and a low. And when I say the highs and the lows, I mean the previous day. It could be the previous week or even the previous month. So the highs and the lows is very important. Like I said, the highs and the lows goes with the M and W formations. But that means you have to understand what kind of M and W formation is you seeing. Is it a macro M formation? Is it a micro? Do you know the difference? So you need to also understand when trading M's and W's that you understand that you want to catch these M and W formations off of the highs and the lows. You want to catch the M and W's off the highs and the lows. So if your M and W is not necessarily off of a high or a low, it's not really an M or a W. So, I mean, it's that simple. Your M and W formations, the higher opportunity to risk reward ratio is going to be off of these highs and these lows. So if you have price done this, and you're expecting it to retrace back down here, and you see it make this move right here, and you think this is an M, like no, that's not. That's a M or a W. That's not an M off of this right here. That's not what you're seeing. So you want to be off of the session breaks. Of course, it creates the first leg off one structure. May do this, create see the first leg is right here, creating our macro. Might get this. Now creating a micro information inside the macro, stop hunt the macro, and drop. So we might get that. So that is the information that we look for. Same is with the W formation. Now, our daily cycle. Now, this is not in any order at all. You know, there's not no order with it. You know, you just want to look for these confluences when you're trading because, you know, why are you trading it? You know, what are you trading this? Why are you taking this position? What do you see that intrigues you to take this trade and be interested in this pair, in this setup? So is it a high or low? Is it an M and WC? Or is it a perfect daily cycle structure you see? So are you trading the daily cycle structure? You know, do you see something, a perfect Asian session, a perfect London session, and then a perfect New York? Do you see that's happening? Do you see the perfect reversals pattern playing out over and over, where it tends to be the Asian session consolidation? You get your London session, like kind of right here, London session created this first M. New York session open here created a second M, as well as we had a micro M right here. This is what I just drew up a little bit ago. Right there. Stop hunting that right there. So, I mean, that's simple, just like that. That's a perfect example of this M and W formation right there. But is it reversing? Do you see a something in this daily cycle where we get the New York tends to reverse the market the opposite direction? Same right here. New York opened up, reversed in the opposite direction. Look, New York opened up, reversed in the opposite direction. So same here. Of course, we see another high over here as a stop on it, and then just stop on it this previous high. That's all it's doing. Stop on it this high right here. Stop on it this one right here. And then this one stop on it this high. So them highs and the lows. Them highs and the lows, them M and W formations, and then trading the daily cycle structure. Understanding the daily cycle structure. So that is very important because now you're not going to always get a perfect, pretty Asian consolidation and then a London breakout, then the New York reversal. You have to start to identify and understand that how these sessions move, and each pair is different. So you have to understand that as well. Now that goes into the weekly cycle structure. You know, this is another confluence. What is the weekly cycle structure? What are we expecting on the weekly cycle structure? Sunday, Monday, Tuesday, starting that trend, that retail trend. Wednesday, Thursday, Friday, reversing the market. So that is another thing we have to keep in mind, as well as the macro time frame, because the macro time frame is also what's going to tell us to determine our weekly cycle structure. Because we're not going to be able to get in on this weekly cycle structure without identifying the macro time frame, because that's going to be very important. We need to know the overall move. We need to know who's in control of this market, as well as identifying your zones. Zones are very important because you want to know where is this market grabbing this liquidity from? Where is they releasing this liquidity? And usually is at the highs and the lows. So same place where they're inducing, same place. So our zones, identifying your zones. ADR is a big one because you need to understand and know what is the daily range of that pair. When will this pair reverse? Have it reached the maximum pips for that day based off of 4 weeks, 8 weeks, or whatever you're calculating? So if you're just trading that pair, you need to understand that pair. You have to understand the pair. You cannot just be trading, bouncing here to pair if you don't understand the pair. You have to as well know the ADR and the correlations. You have to know the correlations. You know the correlations of that pair. If you want to study one pair, know the correlation of that, what moves the opposite of that pair. That way you can have another opportunity to get in on another trades, setup, because this pair is either in correlation or not in correlation with the pair you're studying. So you know what to do with that. Correlations will help you a lot when trading, because to identify and know what trades, pretty much just like the DXY, like studying the DXY, knowing the correlations of it, because then you know what these dollar indexes are doing. So now also you want to ask yourself, where is the accumulation? Where is it at? Where is the accumulation? Where do you see liquidity? Where do you see prices just accumulating orders? Where do you see it? Accumulation. Where do you see accumulation? Because the accumulation is when price is grabbing orders, or one may say consolidation. That is the accumulation, when they're grabbing orders after they just release profits. Where's the accumulation? You need to know where's the accumulation. You need to know who is in control, the buyers or the sellers. Same as looking at this macro time frame to knowing who's in control, buyers or sellers. So that way you know what you should be looking for. You should be buying or you should be selling. What is the overall trend? Remember, the macro time frame is telling the story, as well as who are they inducing, the buyers or the sellers, because as they're accumulating all of these orders, you need to know who's in control, because based on who's in control, the other one is getting induced before they make the move. So who is getting induced? The buyers or the sellers are getting induced. So, for example, if the market maker is doing this accumulation, gaining orders, because everyone thinks it's says it's an uptrend, whatever. Let me draw this a little better. Okay, so we on an uptrend, and prices now accumulation, grabbing orders, up, down, whatever. Now, who's in control? Of course, we see the buyers are in control, right? We see the buyers are in control, right? Who are they inducing? Now, once we get to these highs, playing around with these highs, who are they inducing? To me, it looks like they are inducing buyers as well as sellers. Why? Because this is how the market maker does it. Because they want to take out both traders. They want to take out who's trading on both ends, because whoever's trading with them and whoever's trading against them, they're going to take both of them out. That's their plan. So as the market is inducing buyers, because people are going to keep on buying, thinking the people that's buying this uptrend is just waiting. Now, as well as these sellers are up here, they're just bouncing, trading off this top of this trend line. So what tends to happen? What do the retail traders see? That's the next question we need to ask. What do the retail traders see? The retail traders see this trend line right here, but what we know is, say this is our Wednesday or Thursday, our weekly cycle structure. Of course, they see this trend line. We know what day it is. We see the accumulation, grabbing these accumulation orders up here, inducing the buyers and the sellers, because the buyers are in on this trend for the long run, waiting for it to do this, waiting for it to break. The sellers are just getting in on top of here, getting on top of here. So what it do to induce both? This is what it does to induce both. Now, the buyers are down here. Of course, their stop losses are down there. The sellers had their stop loss up here. So what do the price do? After it keeps on bouncing off of this, gaining all this accumulation, now I got plenty of buyers, I got plenty of sellers in on this pair. Then it spikes up, hit the sellers that was trading with them, take them out the game, reverse, boom, and hit the buyers. Take them out the game, go back and consolidate. So you have to know, where is the accumulation? Who is in control of the market on a macro time frame as well as on this lower time frame where we're entering, because where the retail traders are looking at, as well as who are they inducing. Remember, they're inducing both ends. They're going to induce the buyers and the sellers. But who are we trading with? You want to trade with the market maker. So that inducing is where your stop hunt comes into play, where price tends to stop hunt the previous. Just like here, it stop hunted the previous. It made a high here. Next day, it stop hunted that high, as well as we see a macro and we see a micro inside the macro. So it stop hunted that high before reverse, made a new high for that week. Well, that was Friday, but you get what I'm saying. Monday, right here, made a new high. What it do here? Stop hunt again, this high before reversed. So these highs and these lows is everything. Same down here. We got the lows. Playing off of this low. Playing off Thursday low. Reversed on Tuesday. Off of Thursday low, off these highs and these lows. So these is going to give you your best trade setups, like I said. The best trade setups. So where's the accumulation? Who's in control? Who are they inducing? Remember, they're going to induce both. But who do you identify when it's a downtrend or an uptrend? What do the retail traders see? So that way you know exactly who they're inducing. Because once you understand what the retail traders are seeing, because we know how the retail traders trade, support resistance lines, trend lines, and then the known indicators and etc. So when they're trading these indicators and such, they're getting induced. So we want to know what they're seeing as well, so we can trade the opposite, because we're trading the market maker strategy. That's the way we're trading. So highs and lows, M&W formations off of those highs and lows, M&W formations off the highs and lows, of course, being your daily cycle structure or being the weekly cycle structure to reverse the market. Macro time frame is where you're going to also see these M&W highs, as well as on the lower time frame. Now, the higher time frame is going to give you the bigger picture. That is where the real move is at. Remember that. You don't want to necessarily see think just because it's a small M&W formation inside that session break that is a confluence. Make sure that you see you have more than one confluence behind that. So remember, these are confluences of what I use to trade at. You know, the highs and lows, these M and W's, daily cycle structure, trading this weekly cycle structure, seeing this macro time frame, identifying my zones so I know where price is going, as well as the ADR to help me knowing how much this price should be moving, and then correlations to help me when I'm trading pretty much opposite pairs and vice versa, or just knowing the strength of the dollars or these indexes. So, and then as well as asking yourself, where's this accumulation? Who's in control? Who are they inducing? And what do these retail traders see? So, I mean, you have to make it as simple as possible because we tend to overthink everything, which is called cognitive overload. So, where you're receiving and taking in too much information at once. And like I said, these confluences needs to be back tested. Backtest these confluences alone by themselves. Backtest the highs and the lows, the M's and the W's. Backtest the New York session by itself. Backtest the London. I say this all the time. Backtest each one of these confluences by themselves. So that way you see it for yourself. You start to put it together when you're trading live. So that way it makes sense because a lot of people are having trouble seeing the confluences or having their confluences when they're trading live. You have to understand that you have to trust your own analysis. You have to let go of your emotions and trust your own judgment, So, and use these confluences to get a better idea, as well as checking the dollar indexes of these pairs. Check the indexes, because, use whatever confluence you feel helps you to see what market is doing at that given time. These are the confluences I like to use that helps me knowing when I take my positions.